Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Welcome back after a brief summer hiatus to our September monthly research briefing. CAPIS would like to thank all of you for taking the time out of your busy trading day to spend with us. We hope that you'll find the following information in today's call insightful and that it sparks debate about the capital markets and trading strategies. But before we get started, of course, the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and/or information presented within this presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or solicitation of an offer to buy any securities that might be mentioned. And now on with the call. But before I'd like to turn it over to our special guests, market policy partners, I just want to make sure that everybody remembers that John and Brendan will take questions at the conclusion of their remarks. Please type them into the Q&A portion of your Zoom, and we will be sure to get to them as soon as possible. And now I'd like to introduce my favorite dynamic duo, John Fagan. From 2014 until September 2018, John was the director of the U.S. Treasury Markets Room, and prior to that was a senior macro strategist for Discovery Capital Management, primarily responsible for Asian equity indexes, foreign exchange, and the rates markets. John holds an MPA from Harvard's Kennedy School and a JD from Harvard Law School. And of course, his colleague, Brendan Walsh. From 2006 to the summer of 2018, Brendan was a senior analyst at Discovery Capital Management, covering the global financial institutions section, and was part of the global macro team, focusing on macro data, rates, Forex, and equity indices. Brendan holds an MA from Fordham University in International Political Economy and Development and was an international travel fellow to Manila, Philippines in 2004, working on econometric forecasting models. Gentlemen, welcome.
Thanks so much for having us again. We always enjoy these events and really appreciate the opportunity to try to add value for your clients. Yeah, it's these days, value is a little hard to come by. Just to roll the tape back and to contextualize our comments, Brendan and I had formulated a strategy, an outlook for 2022 in the fourth quarter of last year that essentially called for a year of two halves. The first half of the year being very challenging for risk assets, interest rate hikes, elevated inflation, and certainly we didn't foresee at the time an invasion of Ukraine by Russia, but that's threw gasoline and all sorts of other incendiaries on the fire, and created, certainly turbocharged our call for a very challenging first half, flattening yield curve, falling equities, elevated volatility across global financial assets, and a much stronger dollar. As I said, we paired that with a second half year view that was much, that was improved, that was sunnier, and created basically two twin dynamics of upward impetus for risk assets, being the peaking of inflation and decline, if not rapid decline, but a trend forming nonetheless, and a downshift of Fed tightening from the expeditious or almost panicky 75 basis point clips that were happening in the first part of the year to a more measured 50 and slowing down to a 25 basis points. Initially, we thought that would occur earlier in the year, and so our second half of the year has been playing out. It's to give ourselves partial credit, it's certainly better than the first half of the year, but it's by no means an easy ride. We went neutral on stocks and the dollar at the end of May, and seeing the potential for our base case to play out, we upgraded the stocks and downgraded the dollar at the end of July, stayed neutral on rates, and looked for the Fed downshift and the data to justify that. Since then, it's really been a case of chutes and ladders. we've seen our thesis, glimmers of our thesis playing out, and the market leaning into them, and then having the rug pulled out by a CPI number just earlier, just recently, that changes the narrative on a dime. And so this is, part of the reason our upgrade wasn't a full, a 70% upgrade in stocks, because we acknowledged that it would still take time for this narrative of peaking inflation, moderating and slowing growth, and a downshift in the Fed to really take hold. It's just taking, it's certainly taking longer than we expected. So where are we now? Obviously the CPI, I think that, Brendan and I agree on. Brendan's going to talk a little bit more about inflation specifics here, but, looking back at the CPI number from earlier this week, that I think 3 months hence, 2 months hence, we're going to look back at that and say that was, something of an outlier in a choppy downtrend in price pressures in CPI, PPI, and the other inflation metrics. And while it's, it's not helpful to the narrative, and has cemented the expectation of a 75 basis point rate hike next week, which we are now aligned with. The sense is that the Fed is, I think, past the point of, really being able to react, to need to react to every single number, particularly a number like this, which is disappointing versus expectations, but is not as, in and of itself alarming as some of the other inflation prints that we got earlier this year. And it has to be contextualized around improvements in other inflationary metrics and in the overall kind of context, which is showing a fair amount of declines in prices, in economic activity, and so forth, that should be pointing to a more balanced formulation from the Fed. So we think that next week, what would pass as the fact that we believe the Fed is going to hike 75 basis points and essentially retain its kind of its commentary, like what it had at the end of July, which is going forward, we are going to be responding to the data, but we're not going to be at 70, essentially saying we're not going to be at 75 basis point every meeting necessarily. We've got upside and downside optionality on how we go forward, and so forth. And we think that 75 basis points and relatively steady messaging at this point would qualify as almost a dovish surprise. So we're expecting the meeting next week not to be a game changer for markets, and we think that the ensuing weeks and months will back up our thesis that it's a lack of, it's not the Fed backing off, it's not a pivot, it's just it's a downshift in their trajectory, and we think that that's enough to take the wind out of the sails of the dollar, to calm down the Treasury market, and to give equities a little bit of a better upside potential into the end of the third quarter and into the fourth quarter of this year. Obviously there are plenty of risk factors around this. This is a relatively low conviction environment in general, given the nasty surprises that have occurred, and I think part of this is certainly owing to the geopolitical situation, which is extremely difficult to predict, and so we'll talk a little bit more about that in the future in just a minute here. But just to sum up our overall case, we still think that the evidence and data will continue to point to moderating inflation in the U.S. and generally around the world, slowing growth. The Fed will shift from a 75 to a 50 at its next meeting, and then be at 25 at year end, as it creates a more balanced formulation. Its rhetoric, we believe, will remain quite hawkish because it'll be executing what is essentially a fighting retreat from 75 basis points, and trying to make 50, trying to keep the market from getting too excited about 50 basis points and 25 basis points. And that's essentially, Larry Summers had a tweet that came out today, which is, essentially is very much aligned with our thesis, in which he said it's going to be really hard. The Fed is going to have to get really much more aggressive if they're going to avoid a loosening in financial conditions, now that the market has internalized this terminal rate of 4.25% to 4.5%, which is very high based on recent history, and is essentially priced into the market. Can the Fed incrementally and justified by the data sound even more hawkish than this? We don't think so. And so we actually agree with Larry that it will be hard for them to avoid a loosening of financial conditions, and they won't necessarily be able to do that. And financial conditions will loosen, not in a propel stocks to new highs kind of way, but will be an element of relief, a window of relief over the coming months. Unfortunately, our longer term view is that this runs into the challenging realities of 2023. We think that 2023 will be, the markets will find difficulties in a variety of different factors. One being inflation remains elevated, particularly with the supply shock dynamics of energy and food. This is something that will make the Fed and global central banks extremely reluctant to cut rates. The bar, in our view, for rate cuts is exceptionally high, and you already are beginning to see this in the commentary that's coming out. Rick Mishkin, very influential former Fed official, had an op-ed in the FT basically saying to the Fed, do not make the mistake of the 70s, which is that, cutting too early. And that is now coming into the commentary from Summers, from former Fed officials like Mishkin, and so forth. That the job really is not done when they're done hiking. It's when they have kept inflation at bay for an extended period of time. And we think that this will come into a reality of next year where growth does slow down further. We think that this current environment is a war of attrition against consumers, that right now they're fighting pretty hard, but it's going to be harder and harder for the consumer to remain robust and vital as the headwinds continue to persist into next year. We think that the lagged effects of tightening and the stronger dollar continue to wash through labor markets and business activity. And we think that the economy next year is going to be calling out for a rate cut that the Fed refuses to provide. And we think that that is a recipe for another leg lower next year in a very challenging environment at least in the first half of 2023. So pausing there, I think maybe kicking it over to Brendan to talk more about the specifics of what we're seeing on the inflationary side right now. And then we'll go on and talk a little bit more about the geopolitics.
Yes, the consumer price index was obviously the big print of the week, and really the month also. But I think it's important to, this one I think you want to look at, compare to the July and August readings. The July core CPI surprised very much to the downside. It was a 0.3, where it had been, running at the 0.5 to 0.6. And then the August one came in at a surprise of a 0.6, where people had thought that maybe we had reached peak inflation. I think the reality is probably almost, average the two together. What you saw was a lot of, it was fairly broad-based, which is a little troubling for the Fed, but it was a lot of one-offs, things that in the CPI data went up a significant amount on a month-to-month basis, but it's also stuff that we have real-time data for that is showing a lot of those components are actually coming down significantly. Airfare, and also they have a bit of a problem really for the rest of the year in their rent, the shelter component, because it's done at a 6-month rolling average. So it just takes a while for rental prices coming down to show up in the data. I think that will start to show up in the data in January and February of 2023, because we are seeing it in the real-time data. Rental prices are coming down in basically every major metropolis throughout the country. That's a factor that the Fed has a hard time with, because everything that you see, if you just walk out the door, is the housing market's really, really hurting. But the component of housing within their inflation measurements saying that it's out of control. But then on Wednesday, we got the PPI, which really, I think, highlighted how much disinflation we're actually seeing throughout both the US economy and the global economy. That a lot of the supply chain, huge price spikes we've had are coming off. It's not that we still don't have some supply chain issues, but not like we did, for the 2 years of the pandemic. So the Fed definitely is going to have a hard time balancing. CPI is inflation is a very backward-looking measurement. Both it takes a while for it to come out. It comes out, a month after the thing actually happened. But also the way it's measured, it can be very sticky and slow moving in terms of its changes. So we do think that we've probably seen peak inflation, both on the core and the headline, but that's not going to really matter for the Fed for the next couple of meetings. You're likely to see, pretty similar year-over-year changes. At a minimum, it's going to remain, very elevated.
Yeah, we expect the Fed's messaging on inflation to just sound, as we said, very tough. Even as they're downshifting, keeping the rhetorical pressure on, emphasizing the inflation fight, downplaying the significance of a 75 to 50 basis points downshift, and emphasizing that this fight is continuing. But at the same time, we think that the messaging will begin to acknowledge more of the signs of softening of economic activity, and that will continue on a going forward basis as the economy does that. And we're looking for other potential tells where the Fed begins to get its messaging on inflation a little more nuanced. We've seen other central banks. Other central banks aren't necessarily leading the Fed, but we've seen the Reserve Bank of Australia, Governor Lowe, saying that the outsized 70, big hikes are over. We've seen the same thing from Bank of Korea. We've heard the same thing recently from an ECB speaks with a lot of different voices, but a prominent ECB official saying that the very next set of rate hikes isn't probably going to be as big as the 75 clip that they did. And we think that is going to be, and they've characterized inflation much more as supply shock. We think that ultimately the Fed's narrative is going to go in this direction, where they focus on the supply shock dynamics. Every metric of inflation expectations, they keep talking about how they're really worried about expectations. All the expectation surveys are going really in the right direction. I mean, if you're looking for good news on inflation, that's where it is. You've seen it in the University of Michigan. You've seen it in the New York Fed's inflation expectation stuff. If you look at tips break evens, these are not at worrisome levels. And so
they're back to pre-pandemic levels.
Yeah. Right.
And it's a weird communication dynamic for them where they're saying, we're paying close attention to inflation expectations while they're probably hiking more than they should be. And kind of ignoring what that data is actually saying, if you were paying attention to inflation expectations.
So we think that and the other thing the Fed has done is they've completely abandoned their previous focus on core PCE. Right now, every inflationary number is equally as important as every other inflationary number to the market because the Fed hasn't focused people's attention the way it typically does on their favored metric. We think that's another area.
Which has really painted them in a corner because 40% of core CPI is housing. And that housing measurement is just sticky. So those numbers are always going to be higher than the core PCE, which is a different weighting of all the components. And it's only 20% of core PCE.
Yeah, and by being data dependent, backwards looking, essentially, they've sort of tied themselves to this reactive posture that we've seen, which is okay when you feel like you're behind the curve, but as you get further into a mature hiking cycle, you got to grab the reins, and so we think that is the messaging pivot that may not be coming in this meeting, but we think it's coming in the ensuing meetings, and will be a at least relatively.
When you have a market that is pricing in rate cuts in 2023, it makes sense to maybe start backing off these huge hikes in the intermediate time, so that when it comes time for things to slow and the market's pushing you to cut, maybe you don't have to cut because the economy isn't quite as weak as the market was pricing in today.
Yeah, and when we see other central banks doing this very thing, ECB, Reserve Bank of Australia, other prominent central banks taking that downshift path, we think that that is going to be where the Fed is going to join them there.
Also, the Fed really does have to start paying attention to the strength of the dollar.
Yes, that that's a major issue, and it's one that they've really let play out. We've seen the Japanese essentially doing a lot of feints in terms of currency intervention potential. But our guess has been that that is not going to drive an abandonment of their ultra easy monetary policy. They're going to take what the currency market is giving them in expectation that probably the Fed maximum Fed hawkishness is going to come off the peak here and give them a little bit of relief. But essentially, we're watching the Plaza Accords unwind in real time and change the dynamic. I don't think that the Japanese are really all that serious about trying to, about what I think Kuroda would characterize as snatching defeat from the jaws of victory. We take him at face value that he is looking at, the inflationary dynamics as very transitory in Japan, and that he doesn't want to return to the status quo ante, which was too low inflation. And so we expect the central banks to be in a global dance, but eventually start to coordinate their movements a little bit more after this period of pretty wide divergence. And we think that will be ultimately in the back half of this year, in later third and into the fourth quarter, would be pleasant for the markets. Unfortunately, our longer term view on inflation is structurally higher. Part of it, and we'll talk about, is the continuing.
Well, not necessarily, unfortunately. It has been the Fed's goal for the last 25 years to raise inflation.
That's true. And
2% was kind of an arbitrary point that we chose 25 years ago.
And it created
all the data hasn't necessarily shown that 2% is right. 3% could be just as fine.
Yeah, and it created, as we all were aware, the ZIRP, the lower for longer years, the great moderation years after the global financial crisis, in which liquidity was ample and could be so because inflation was never a risk, and the central banks could do whatever kind of monetary magic they wanted to perform at any given time, and we think that that era has come to a rapid close, and in 2023. The idea of looking for a recovery in the economy, like a further recovery in the economy and in asset markets without that support that we'd come to expect, reflexively over the past decade. And when we look at great power competition, we look at, the scramble for resources, fragmentation, balkanization of global supply lines, reversal of globalization into friendshoring and reshoring, national security and economic policy and government intervention becoming just, much more the econ policy and industrial policy and markets becoming ever more intertwined here, the pendulum swinging back toward labor. And we think that all spells a period of, this is a significant period of transition for the markets. We don't think that it is an event. We think it's a process. We think that we're, nowhere near maybe we're at the end of the beginning of that process rather than beginning of the end. We think it certainly has ways to go, and will challenge asset markets on a going forward basis. So just shifting into geopolitics, the national security folks that we talk to here about the Russia-Ukraine situation, it's extremely fluid. The gains for the Ukrainians in the east, their counteroffensive, enormously successful. But is the Russian army ready to leave the field and cede their gains? Is Putin going to be, is this going to be the conclusion of his presidency? The reality is, the national security folks that we talk to here in DC are, very unwilling to believe the rumors about a coming coup to depose Putin. His inner circle is, in their estimation, is as hawkish, if not more hawkish, than he is. This is a up the ante kind of group, and they don't have serious domestic opposition. We've heard some rumbles from regional, like mayors and some local political leaders. That's a very about maybe how Putin should leave office. That is that kind of statement by a Russian political leader should come with a Surgeon General's warning. That's very bad for your health to say something like that in Russia.
Fall out of a window.
Yeah, and so our expectation is that that the Russian army may be a disaster, but they are certainly willing to feed men and material into a meat grinder, and certainly for the near term, defeat and retreat is not an option for Putin politically. And so we think that this turns into, at least in the near term, a relatively frozen, bloody stalemate that, the front moves back and forth, but doesn't change very much. Crimea remains, the redoubt of Russian holdouts. And it's, and Russia certainly doesn't appear to be letting off Europe or the rest of the world off the hook with energy as a weapon. And so we don't see a swift resolution, but of course, this is a very fluid and unpredictable circumstance. But we think it goes into a chronic condition. China's support with Xi's visit, I think that is part of the life support system that Russia is trying to cobble together. We think that the G7 efforts to cap Russian oil prices have too many moving parts and too many ways to get around it, and it's been too well telegraphed to the Russians by now. And this is going to be a challenging winter for the EU, no question. And we think that feeds into our belief that the European Central Bank is going to be loath to be hiking aggressively into a very dark, cold, and miserable winter in the EU. Speaking of China, we are not concerned about we're not. We think that the risks around Taiwan obviously wax and wane, but we don't see that as a likely flashpoint, particularly with the object lesson of the perils of that kind of adventurism being seen in Ukraine at the moment, and U.S. basically weapons deals and that sort of stuff, increasing intensity. China also has a lot of stuff to deal with at home. We don't think that the anointment of President Xi for his third term, essentially president for life, which is coming up this October, we don't think that will mark a major turning point in a complete abandonment of COVID zero and or a major re-up in stimulus or anything to that effect. To the extent that they were going to really ramp up stimulus, they would have done it prior to this event, in our view, rather than afterward. And we think that they are in damage control mode, trying to keep the property market problems from going systemic, and essentially letting the currency and growth be suboptimal because they can't save everything at the same time. And so we have our view on China this year has been dead money. And we think that the stimulus had been coming. We expected that, but we didn't think it would be a particularly exciting level of stimulus, and enough to keep things from sliding off into the ditch, but not to create a significant impetus for upside for the economy or Chinese markets or the renminbi. Let's see. We've covered our thoughts on U.S. energy policy. It looks like this, there's going to be a back and forth on, the Biden administration has been very free with the Strategic Petroleum Reserve, and they're going to be on the gas and the brakes. They're going to be trying to refill it while it's not a particularly coherent strategy, but it's.
I'm not sure why you told the market what price you want to buy it at.
Yeah, the fact that they're buying it at 80, I think it tells you, like, right there, that's your floor. Yeah. And so we doubt that oil prices will have a significant relief in the near term, barring some massive shakeup at the top in Russia. And so our expectation is that the U.S. energy policy will remain very scattershot, with the Strategic Petroleum Reserve kind of filling up, letting out, and this is a pre-midterm kind of you got to pull some levers if you're the White House, and you might as well use it if it's sitting there. And is that a great long-term strategy? Of course not. But that's the near-term political realities dictating that decision. In terms of the what's happening on Capitol Hill with the permitting and that sort of thing, that looks like it's going to end up in deadlock, with the two sides and Manchin sort of waiting at the altar here, potentially as we get closer to the midterms, and not a whole heck of a lot gets done. Our outlook for the midterms is, the base case is that the Democrats now keep the Senate and the Republicans take the House. that is, I think that's expected at this point, and deadlock is priced in. I think that the Democrats outperforming and keeping the House very unlikely. More likely,
no, it's not likely, but better and better by the day for the Democrats. Now we know who a lot of the midterm on the Republican side, and a lot of those candidates are very, very much Trump. And then the Roe versus Wade issue came out of left field and has been really a gift from heaven.
Absolutely, yeah, and political pundits polls are pretty garbagey anyway, and in this unprecedented environment where you have new voters coming in and motivated, pockets of voters who are being motivated by elements that are relatively unprecedented, this is a real question mark, and so I don't think anybody should get particularly confident about any view coming into the midterms. But sticking with the base case that we get some form of gridlock over the coming years, what are the long-term policy aspects that we expect? Where do the Republicans and Democrats really align? They align in opposing big tech, and so there's a potential for a big tech for the post-midterm political environment to have some momentum on tech, a focus on tech, but that's a very, very challenging and thorny issue. More likely, I think we get political action on, continued political action on China, where you get, pressure on, basically the Biden administration is able to review their, the post, in the post midterm environment, they review the Trump era tariffs and that sort of thing. And we don't think that this is going to be a big directional shift. We think that this is going to be refinement. And when they tweak something, they're going to tighten something else. And we saw, more tightening of chips, but you could certainly make the case that, loosening up on some resources might be something that they would be open to. And so it's watch this space, but we don't think it's a major reversal of the ongoing trend of trying to find non-Chinese supply lines certainly for strategic and critical elements. Let's see, some of the other things that are relatively bipartisan. Well, there's a crypto, the regulation of crypto. We think the SEC and Gensler keeps hammering at this. The SEC is absolutely intent on classifying them as securities. They see the tokens as securities. And the legislative process a little bit more, leaning closer to the CFTC, which is a little bit of an easier regulatory road, and so that's certainly a tension there. Our view is that the SEC is they've got a pretty strong case to make, and by the definition of securities, and certainly the way that the industry has progressed, but it is lobbying has certainly been taking place. So but
if it comes down to the regulatory, if Congress can't pass a law defining who regulates it and what things should be classified as, it's very likely that the SEC wins this case and crypto falls under its jurisdiction as securities, as assets.
And and just from everybody paying attention to crypto, the idea that it's Bitcoin and that sort of thing is digital gold, inflation hedge, that sort of thing is not really playing out in the price action in the way that the advocates had hoped. But Bitcoin is currently holding its lows. We think that it gets swept up in the second half rally that we expect, or the late third, early fourth quarter rally that we expect, like all of the risk assets. But unfortunately, our tradable rally thesis for crypto looks a lot like our other risk asset thesis, which is ride it up, but it's a rental, not a rally to really buy and hold after we get through that sort of holiday period into 2023. Pause there for questions. If we have any from the audience, we can crash through some
Yes, we do have
some
questions.
other views. If we don't have any questions, but Oh, great.
Yeah, we do have some questions. I'll read the first one here. And it is, with the future potential of the economy softening, where do you see the US dollar?
So our thesis is that the US dollar backs off its kind of double top highs here in the near term and through the second half of quarter three and into quarter four. We get with the Fed downshifting, with the economic slowing, with the monetary policy trajectory converging or coming back closer into convergence rather than the widely divergent trend that we've seen. We think that allows the dollar to ease back, but we don't think it's a massive we don't think it's a massive decline. We don't think that the dollar is going to trend downward. We think that in a multi-quarter, multi-year move, we're concerned that this is a false dawn for the dollar, and coming into next year, we see as expectations for Fed rate cuts and Fed easing sort of move get priced out, and an expectation that the Fed is going to essentially try to keep its rates restrictive for the medium to longer term in the face of elevated and sticky inflation. We think that is a recipe for another run up in the dollar, and we're wary that it comes right back to these highs or even potentially exceeds them into next year.
Okay, we got a second one here about Taiwan. Regarding the Taiwan situation, would you say that if China is going to invade, the longer they wait, the more challenging it will be for them due to their demographic and economic issues, plus the increased arming of Taiwan?
I absolutely agree with that. Yep, I couldn't agree more. I mean, the Taiwanese are taking a look at what's working in Ukraine, the weapons packages and the U.S. support and the Western support. I think is they're gonna ramp it up. This would be under the best of circumstances, this is a big challenge. Amphibious assault.
They're an island. They're not. You can't just drive over there.
Yeah, amphibious assault on a bristling island without pleasant sandy beaches necessarily to put a lot of troops in. The Chinese military isn't particularly, they may be large and well equipped. They're not particularly battle tested, and certainly with something as complex and difficult as an amphibious landing, and essentially what would have to be led up with a bombing campaign, and with civilian casualties and a terrible toll, I think, on both sides, and one that ascent from a political situation, just like Putin, that President Xi or whichever president orders that action politically has to 100% cannot lose, and because that would be an existential threat. A failure to retake Taiwan would be an existential threat to the Chinese Communist Party, essentially, and you would have the risk calculus is very challenging there at a time when you can look at the situation in Hong Kong and just say, slowly co-opt, change the system. A huge swath of the Taiwanese middle class is in China, right? There are ways to co-opt and reabsorb in that don't require enormous ballistics and that sort of thing. I think the other point to make is the U.S. the strategic clarity that the U.S. keeps trying to put forward is we will defend Taiwan. That wasn't the case with Ukraine, and it's drawing a pretty red line. Whether the Chinese believe it or not is they have to at least respect that there's a non-zero possibility that the U.S. wouldn't let them do it, and we would have something to say about it. And that's a very challenging thing. The other thing we hear from national security guys, and maybe people have heard this as well, but the first sign, one of the first things the U.S. would do at the sign of a Chinese invasion would be to cruise missile all of the chip plants, to deny the Chinese the ability to capture those and utilize those. That is the understanding of the national security is that the Chinese the Chinese chip makers would be bombed flat to deny China the ability of getting them before they even touched the rocky beaches of Taiwan. So it's but the calculus that a lot of the national security folks that we talked to almost unanimously ahead of the Russian invasion of Ukraine was, it sure looks like they're going to do it, but we don't think they will because it would be insane. It would be an insanely stupid decision. And sometimes people make insanely stupid decisions.
But they all thought it would be a weekend war and Russia would win it initially, and then it'd be stuck with Ukraine. So Ukraine has done, the unthinkable in military circles, and a lot of that had to do with the drones and the missiles that came from the West.
All righty. And we have another question here, and this has to do with the EU. With the German economy under pressure, do you expect any member changes in the European Union?
I think that the European Union actually has been, I think that it's the current, the situation that we're seeing in Russia has been very galvanizing, I think, to the European Union. I think it's actually, the pandemic has been the pandemic forced the EU into essentially a fiscalized and sort of central, almost like a federalized kind of debt structure for the very first time in a meaningful way. The ways in which the ECB has oriented itself to direct its bond purchases toward the weaker credits and the periphery has generated a lot less pushback from the Northern Europeans. Some of the leading lights of that kind of fragmented Europe. Angela Merkel was a very local politician, and she was always criticized not having a particularly European outlook. She's left the scene, and there isn't necessarily a strong any strong kind of driving person at the top of the politics in the same way that Merkel had been, and so I think that there's the power does shift to Brussels in that circumstance. If you don't have Mario Draghi in Italy, you don't have Merkel, you end up with a increasingly the European Commission is the pole of power moves that way. And I think that this is a situation in which Europe is under for all of the bureaucratic nightmares and difficulties and the length of time it takes them to get decisions made and that sort of thing, these external pressures of COVID and then Russia invasion of Ukraine, from our view, has been very galvanizing to the bloc. Brexit as well has been galvanizing, and so we think that in terms of European cohesion, we think that recent events, as bad as they are, have actually made them hang together rather than want to hang separately.
And now work together on an energy solution outside of Russia.
Yeah, it's a shared problem, and the difficulty of getting everybody to agree. There really has been I think a lot more focused minds and clear-headed action, clear-eyed action out of Brussels than we've been given to expect.
All right.
Whether that's going to save the day in this winter, we had Gazprom coming out this morning and saying, even if your storage tanks are full, you're still going to be suffering. But got to take Gazprom's what would they say? And
they have to speak their own book.
Yeah, boy. I mean, if you're running Gazprom these days, I'm sure you've seen the list of Gazprom executives. I don't know how they get life insurance because it's a grim tally these days.
All righty, guys, we're coming up against our mark, and I don't have any other questions in the queue. So with that, I'm going to bring the monthly CAPIS research briefing to a close. We'd like to thank everyone, including John and Brendan of Markets Policy Partners, for participating and sharing their insights with us. Our next research briefing will be on October 20th, and it will feature Katie Stockton of Fair Lead Strategies. So we ask you to stay tuned. Keep up with CAPIS on social media, LinkedIn, Twitter, and of course the CAPIS YouTube channel, where you'll find a replay of today's event. On behalf of CAPIS and Markets Policy Partners, thank you for watching and have a great trading day. Have a good day, guys.
Thank you.
Thanks, John.